Disclaimer. Silver has just breached the historical threshold of $120 per ounce, a milestone never before seen in financial history. However, the price tag is merely a symptom. The true story lies in the systemic catalyst in Beijing and the unfolding reaction in America that will make $120 seem like a bargain. Here is the critical intelligence you need immediately. A major Chinese silver investment fund was forced to suspend trading at 11:37 a.m. Beijing time on January 28th, marking its second halt in a mere 96 hours. Simultaneously, in Shenzhen, 352 investors are stranded waiting for compensation after their silver dealer defaulted on physical deliveries and shuttered operations. Meanwhile, in the United States, the Department of Defense has officially activated DPAS priority ratings under the Defense Production Act. This signals a definitive shift. When the military-industrial complex requires silver, they are legally first in line, leaving the civilian market to fight over the scraps. To visualize the mathematical impossibility we face, COMEX registered inventory currently holds just 40 million ounces. In contrast, our government's new strategic acquisition target is 500 million ounces. The disparity is fatal. If you currently hold paper silver, be it SLV shares, futures contracts, or unallocated accounts, you're about to discover those assets are worth the paper they are printed on. The physical market is actively decoupling from the paper market, and only one will survive the coming correction. January 28th, 11:37 a.m. Beijing time. The China Investment Silver LOF Fund triggers the circuit breaker, bringing trading to a complete standstill. This is not a minor peripheral fund. It serves as a primary vehicle for Chinese retail investors seeking exposure to the silver market. The fact that this is the second halt in 4 days signals a systemic liquidity crisis. What makes this situation truly unprecedented is the valuation at the moment of the halt. The fund was trading at a staggering 62% premium over its net asset value. Consider the implications of that metric. Investors were voluntarily paying $162 for every $100 worth of actual silver exposure. This is not the behavior of rational market speculation. It is the behavior of panic buying driven by a population that understands a fundamental truth the rest of the world has yet to grasp. The fund had plummeted 20% in 48 hours, hitting limit down twice, only to violently reverse and hit limit up. The Shanghai Exchange has since threatened to freeze the accounts of what they term abnormal traders, a euphemism for retail investors who refuse to stop buying regardless of the skyrocketing price. These are not gamblers betting on a rally. These are everyday citizens who have decided that physical ownership is worth any premium, because they see their access to the metal vanishing before their eyes. Let us shift focus to the Shuit district in Shenzhen, widely recognized as the jewelry manufacturing hub of southern China. This area is typically teeming with hundreds of small dealers selling everything from ornamental gold chains to investment-grade silver bullion. On January 28th, however, the scene was one of desperation, with 352 people gathered outside a shuttered dealer's office waiting for compensation that will likely never materialize. The dealer defaulted on physical delivery obligations and vanished. Yet, the most alarming signal is not the default itself, but the industrial shift occurring nearby. In the last 2 weeks, 6 major jewelry manufacturers in the district have permanently dismantled their silver jewelry production lines. This is not a temporary pause, it is a total strategic pivot. They are retrofitting their facilities to produce investment bars exclusively. Simply because the profit margins on jewelry can no longer compete with the premiums, desperate buyers will pay for 1-ounce investment rounds. This is the anatomy of a supply crisis. When established manufacturers cannibalize their own product lines to chase premiums in the investment market, it confirms that the supply chain has fundamentally fractured. Now, we must analyze the policy shift that occurred on January the 1st of this year, a move by Beijing that removed more silver from global circulation than the market has priced in. China implemented a stringent new export policy, slashing the number of authorized silver exporters from thousands down to a select 44 entities. Pop quiz, do you know the requirements to remain on that list? A company must now produce at least 80 tons of silver annually and maintain credit lines exceeding 30 million. This single policy change instantly vaporized approximately 2,000 tons of annual supply from the global export market. That is 64 million ounces that previously flowed from China to refiners, dealers, and industrial users around the world. That flow has been severed. According to the World Bureau of Metal Statistics, China consumed 450 million ounces of silver in 2023, representing roughly 55% of total global mine production. Their consumption is compounding at 15% annually, while global mine production is stagnant at barely 2% growth. Project that math to 2027, and you face an inescapable reality. China alone will consume more silver than the entire planet produces, even before factoring in the industrial demands of the United States, Europe, and India. The physical premiums currently paid in Shanghai provide the clearest signal of the unfolding reality on the ground. On January 28th, buyers were paying a 15% premium over the spot price for immediate delivery of silver. Just 2 weeks prior, that premium was only 5%. The premium is effectively doubling every 10 days, indicating that supply is evaporating faster than the pricing mechanisms can adjust. To make this tangible, imagine you operate a solar panel manufacturing plant in California requiring 50,000 ounces of silver monthly. 3 months ago, you placed an order and received it in a week. Last month, the lead time stretched to 2 weeks, and the price rose 8%. This month, your supplier informs you they can only fulfill half your order, perhaps in 3 weeks at a price dictated by the Shanghai morning fix. This is not hypothetical. Industry sources tracking industrial procurement report that lead times have tripled since December 2025, and many manufacturers are reporting that their long-standing suppliers are simply ghosting them on new orders. Consider the perspective of those Chinese investors paying 62% premiums for the halted fund. They are not acting irrationally, they are acting with foresight. They can see their government locking down export supplies. They witness jewelry manufacturers shutting down lines to mint bars. They see dealers defaulting and vanishing. They understand that by 2027, the arithmetic of supply and demand will result in a hard failure. Their nation will require more silver than the global mining industry can provide. When this mathematical reality becomes undeniable, civilian access is always restricted before industrial access. Therefore, they are buying now, before $120 becomes $200, and before the coming allocation systems make physical silver unobtainable for the average citizen. The Silver Institute reported that China imported 108 million ounces in 2024, produced 113 million ounces domestically, yet consumed 450 million. The math implies a gap of 229 million ounces. Where did it come from? It came from aggressive inventory drawdowns and recycling that cannot be sustained. Those stockpiles do not regenerate, and with new export restrictions, whatever silver remains in China stays in China. In Beijing, policy analysts tracking these commodity flows describe this phenomenon as strategic accumulation through supply restriction. While it sounds like academic jargon, the practical application is blunt. China is not merely buying silver on the open market, which would drive prices up and trigger an international response. Instead, they are quietly choking off exports while allowing domestic consumption and investment demand to vacuum up every ounce their mines produce, along with existing dealer inventories. The net result is identical to a massive government buying program, but it occurs invisibly through private transactions within a closed loop where export supply perpetually shrinks. Have you observed the recent movement in silver lease rates? Historically, the cost to lease silver runs between 1.3% and 4.5%. As of January 2026, those rates have spiked to 8%. This means entities are paying 16 times the normal cost just to borrow metal for delivery. They aren't borrowing to speculate. They are borrowing because they have contractual delivery obligations they cannot meet, and they will pay any price to avoid default. These rates confirm that institutional players see the shortage coming and are scrambling to secure metal before the market dries up completely. The U.S. government activates defense protocols. When you connect these disparate data points, the fund halts the explosion in premiums, dealer defaults, manufacturer conversions, export bans, and lease rate spikes. It becomes clear this is not a bull market driven by investment enthusiasm. It is a supply crisis already in motion. The people closest to the physical metal are panic buying because they see inventory vanishing, and all of that chaos was just the prelude in China. Now, let me explain what has transpired here in America. If you thought the breakdown in Beijing was dramatic, the mechanism our government activated 14 hours before silver hit 120 will determine if you can even access physical silver by summer. On January 7, 2026, an executive order was signed that went largely unnoticed due to its bureaucratic language. It built upon Executive Order 14241 from March 2025, activating Titles 3 and 7 of the Defense Production Act specifically for critical minerals. Translated into plain English, the United States government has granted itself the legal authority to control the nation's silver supply, and they are already exercising that power. Title I of this act is the most immediate concern because it is affecting the market right now, largely invisible to the public. Title I authorizes DPAS priority ratings, the Defense Priorities and Allocation System. In practice, this means when the Department of Defense issues a priority rating for silver, that order legally jumps to the front of the line, overriding all other contracts. Suppliers cannot refuse it. If you are a silver dealer or refiner with 500 loyal customers and existing contracts, receiving a DPAS-rated order changes everything instantly. You are legally required to fulfill the government's demand first, even if it forces you to breach contracts with every other commercial client. Refusal or prioritization of commercial customers can lead to the seizure of your facility. Major dealers are already reporting that entities with government connections are placing massive classified orders protected by non-disclosure agreements. These are not retail purchases. They are single transactions that consume 6 months of a dealer's typical inventory, executed by organizations that provide nothing but the necessary priority rating documentation. Let me demonstrate what these priority ratings are building toward, because there is a specific target number that should alarm every investor. According to Department of Defense procurement planning documents and the Development Finance Corporation's strategic initiatives, the U.S. government is preparing to acquire 500 million ounces for strategic reserves. To contextualize this, total U.S. mine production is roughly 80 to 85 million ounces per year. This 500 million ounce target represents approximately 6 years of total American mining output. The government intends to acquire this massive volume, while domestic industrial demand continues unabated, while the U.S. Mint attempts to produce coinage, and while jewelers and electronics manufacturers fight for supply. The math is impossible unless a large segment of the market is cut off, and it will not be the Defense Department that gets cut. Title III enters the picture here, authorizing the use of the Defense Production Act Fund, which holds over $700 million in available budget. Furthermore, it allows the DoD Office of Strategic Capital to intervene directly. In practical terms, this allows the government to sign off take agreements with mining companies, effectively purchasing silver production before it is even mined. If you are a mining company and the government offers an agreement guaranteeing the purchase of 80% of your output at a fixed price for 5 years, you take the deal. It offers guaranteed revenue, classification as a critical defense contractor, regulatory exemptions, and access to government financing. The miner wins and the government wins. But if you are a refiner, a dealer, or an individual investor relying on that mine's output, you have been legislatively cut out of the supply chain. These agreements are being negotiated right now. Sources indicate the DFC has been in active discussions with at least 7 major producers since December 2025. The goal is clear: lock up future production before the shortage allows miners to demand premium market pricing. The collapse of civilian access. Consider the recent actions of the U.S. Mint as they serve as a bellwether for where this is heading. In November 2025, the Mint suspended all numismatic silver products, the collectible sets, and special editions. By December, they announced the 2026 American Silver Eagles would be delayed, with a new release date of February 26, 2026. The official excuse was production challenges due to rising prices. The reality is that the 2026 Silver Eagles sold out before release. Dealers accepted pre-orders based on allocation numbers, and demand exceeded the entire planned mintage before a single coin was shipped. The Mint did not stop production because prices were high. They stopped because their silver supply is being diverted. They simply cannot maintain previous production levels when government priorities have fundamentally shifted. Do you recall when the United States maintained a strategic silver stockpile? We held 165 million ounces as recently as 2002. The government sold all of it. Every single ounce was liquidated. For 2 decades, we operate on the assumption that silver could simply be bought on the global market when needed. That assumption is now dead because China has locked down exports, global production has failed to match demand, and modern warfare, from Tomahawk missiles to F-35 fighter jets, requires massive amounts of silver. Military procurement specialists confirm that, depending on the system, a single missile can contain between 10 and 500 ounces of silver. When the U.S. military needs silver for critical weapons, but has zero reserves and relies on imports for 64% to 80% of supply from a breaking market, they do not negotiate. They activate the Defense Production Act. They issue priority ratings. They sign offtake agreements. This is exactly what is happening today. According to the U.S. Geological Survey, American mines produced about 910 tons of silver in 2024, or roughly 29 million ounces. However, the Silver Institute reports that U.S. industrial demand alone consumed approximately 180 million ounces that same year. We are importing over 5 times more silver than we produce domestically. That import lifeline is shrinking because China, a major source of refined products, is closing its doors. Picture the scenario currently playing out in procurement offices across American manufacturing. You are a supply chain manager for a medical device or electronics company. Last year, you had 3 reliable suppliers. Today, one has stopped returning calls. The second can only fulfill 60% of your order with a 6-week lead time. The third has voided price guarantees. You are unaware that your suppliers are fulfilling DPS priority orders, cutting their commercial availability in half by law. This is a stealth allocation system restricting civilian access 1 contract at a time without public announcements. Title VII of the Defense Production Act grants the government authority to establish voluntary agreements with private industry to meet national defense needs. The term voluntary is heavily loaded. When the Department of Defense suggests you voluntarily prioritize their orders, the implicit threat is obvious. Cooperate now, or they will utilize Title I to mandate compliance later. This situation is alarming because the variables are converging on a breaking point. China is restricting exports. The US is activating defense authorities. Global mine supply grows at a meager 2%, while demand surges at 8% to 12%. The math reveals an annual deficit of 95 million ounces between production and consumption. This deficit has been plugged by draining existing stockpiles. But COMEX registered inventory sits at only 40 million ounces. London vaults hold perhaps another 50 million in deliverable form. Let me break down the math that makes $120 silver not a peak, but a stepping stone. The paper silver market rests on a terrifying leverage ratio. Approximately 356 paper claims exist for every 1 ounce of physical silver. This scheme functions only as long as investors are content holding paper. But what happens if just 10% of those paper holders demand delivery? That would result in 35.6 claims for every single ounce in existence. COMEX does not have it. ETFs cannot source it. The system fails. This 10% threshold is becoming inevitable because the Defense Production Act is forcing industrial users to hoard physical supply. When a manufacturer realizes just-in-time delivery is dead, they buy and store physical inventory to keep their factories running. This simultaneous industrial panic buying is the catalyst that shatters the paper market. According to the Silver Institute, the global market runs a 95 million ounce annual deficit. Extend that over 5 years, and you need to draw 820 million ounces from stockpiles. But COMEX has 40 million, London has 50 million, and China is removing 150 million ounces from the export market every year. We are facing a scenario where available supply shrinks by 150 million ounces annually, while the deficit demands another 95 million from depleting stocks. Add the US government's 500 million ounce target, and the March-May 2026 timeline is not speculation, it is arithmetic. The breaking point is visible on the horizon. There are 3 paths forward, and the government will choose one in the next 60 to 90 days. Path 1 is voluntary cooperation, where industry patriotically agrees to prioritize defense needs, an unlikely fairy tale. Path 2 is allocation and controls. The government uses the DPA to mandate distribution, limiting civilian purchases, and instituting reporting requirements. This is the most likely outcome as it offers control without admitting a crisis. Path 3 is emergency acquisition. A geopolitical shock forces the government to seize stockpiles and force sales, making civilian access impossible. Given the active DPAS ratings and off-take negotiations, we are already deep into Path 2, with Path 3 just one crisis away. Finally, understand why $120 is not the top. Citibank forecast $100 by March 2026 based on standard supply deficits. They did not factor in the Defense Production Act or China's export ban. If the Defense Department adds just 50 million ounces of annual demand, only 10% of their target, the global deficit spikes by 50% to 145 million ounces. Commodity markets react to such shocks with violent repricing. Analysts now project a sustained floor between $120 and $150 by Q2 2026. This is on a spike. It's a new baseline. This means everything you buy containing silver, solar panels, EVs, electronics, is about to double in cost. The lease rates tell the final story. At 8% compared to the 0.3% norm, the short-term market is broken. We are witnessing the bifurcation of silver, allocated supply versus available supply. Shanghai trades at $80, while COMEX quotes $71, a 15% disconnect. When that gap widens, the paper market will collapse and settle for cash, while the physical market trades at true scarcity prices. Dealers are already charging $8 to $12 premiums, and notify me when available is becoming the standard status. This is not a drill. The allocation system is active. Supply is being diverted. The question is not if silver hits $150, but whether you will hold physical metal when the paper market burns. In a war for resources, paper promises always lose. The window to act is measured in weeks.